Hey everyone, quick U.S. market recap in plain English. Today's story is simple. Stocks held up or pushed higher, while the 10-year yield stayed elevated, and that mix tells us a lot about what the market is really pricing right now. Three charts on screen. SPY, the broad S&P 500 proxy. QQQ, Nasdaq and megacap tech, and TNX, the U.S. 10-year yield, basically the gravity for stock valuations. If you understand the relationship between QQQ and TNX, you understand most of the daily market moves. Let's start with TNX. The 10-year yield finished around 4.17%, slightly lower on the day, but still very high in the bigger picture. Why does that matter? Because when yields sit up here, the market's basically saying, we're not convinced inflation is fully done, or we're not convinced the Fed is ready to cut fast, or growth is still strong enough that rates can stay higher. Now, notice the intraday behavior. TNX had a choppy morning, then mostly stabilized. That stabilization is key. It reduces panic. When yields spike hard, tech usually gets hit first. But when yields are high but stable, the market can rally anyway. So the message from TNX today is pressure is still there, but it didn't get worse. Now look at QQQ. It closed close to roughly plus 1%, and even after hours, it held near the highs. That tells you investors still want exposure to growth plus big tech, even with yields elevated. Here's what that implies. The market is still rewarding quality growth and liquidity magnets, the names that institutions can scale in and out of. If yields don't surge, QQQ becomes the leadership engine again. If yields jump, QQQ is usually the first place you see stress. Today, we did not get that stress. Instead, QQQ trend stayed constructive. That's basically the market saying, we can live with this yield level for now. On SPY, the move was also positive. Not as aggressive as QQQ, but importantly, the broader index didn't break down. That's a strong signal because it suggests the move isn't just one or two tech stocks dragging everything. It looks more like buyers are still present, dips are still being bought, and risk sentiment didn't crack. So when SPY is green and QQQ is leading while yields are steady, that's typically a risk-on with cautious setup. So what's the market really pricing? It's pricing a world where rates stay higher for longer but don't explode upward, and earnings and growth expectations hold, at least for the biggest companies. The next catalyst is always data, jobs, inflation, and Fed communication. This is why traders stay glued to the calendar. The market can look calm, and then one print changes the yield path instantly. So today's logic is, yields didn't worsen, so tech stayed strong, so SPY stayed supported. That's the chain. Going into the next session, here's the simplest checklist. If TNX breaks higher, expect QQQ to feel it first. If TNX stays stable or drifts lower, QQQ can keep leading and SPY can grind up. Watch for any sudden yield shock. That's usually when the tone flips fast. If this breakdown helped, drop a like and subscribe. I'll keep these recaps short, visual, and actionable.